Yo, what's up, people? Cav here, 30th of September, end of the month. And yeah, like, I guess people have been wondering where I'm at. I mean, I've been like keeping people updated in a sense that the thesis hasn't changed, i.e., we expect further downside and the lows that aren't in. So, high level, people still know where I stand because I'd be very clear if anything had changed. However, I guess I think it's worthwhile just running through some reasons as to why I think getting long here is not the right idea. Yeah. And I'll, as I always do, list the reasons kind of off the top of my head, and then what I'll do, I'll follow up with some charts, so you kind of get commentary plus some charts as well, maybe with a couple one-liners. So first and foremost, a metric which I keenly keep an eye on is a metric called the long-term holder spending binary, and it's essentially an oscillation between 0 and 1, and the lower, more towards 0, means that you're seeing less activity, less spending behavior from the long-term holder cohort, and then the closer it is to 1, the more spending. And essentially I think it's calculated by measuring sort of daily movements from that cohort, like daily spending activity relative to a mean, and if it's above the mean, let's say it's 30 or 90 day, that's the mean. If it's above the mean, then binary b equals 1, and then it kind of measures from a broader scale. So anyway, it gives quite a clean oscillation, and gives me quite a clear insight into the activity of long-term holders from a spending perspective. Like, how comfy are they, and how actively are coins being moved? So I feel kind of referred to it as hot potatoes, right? If the coins are being kind of moved about a lot, which is normally seen alongside periods of distribution and swing highs, that's not really what you want to be seeing, because in the BTC market, it's largely driven by a lot of macro factors, but also we do have these idiosyncratic nature of old dormant coins, or people that have bought the lows 3 years ago that don't give a fuck about 7% deficits from here on out, right? They're up 5-6x, and they're seeing these treasury companies take on leverage, or they abide by a 4-year cycle, or whatever it is, right? What we have seen this cycle is the better places to be looking for swing longs are when spending activity is low. All right, so that's number one. Point number two, which for me is really, really key, is we still have yet to see any meaningful velocity on downside deleveraging. And I think this is very important because it feeds into point 3. So this is point 2. It feeds into point 3, and that is essentially the grounds, the fertile ground for a swing long, right? Multi-week, multi-month swing long this cycle have actually come from periods where we've seen a deleveraging, a sharp move to the downside, historically speaking, kind of 22 to 27% decrease in OI is the sort of band that which we have seen this cycle. So it's a sharp deleveraging, a sharp move to the downside that shifts the psychology of the market participant, right? And then that shift manifests and is visualized by periods where you actually have daily negative funding. and like sustained periods. So you'll have like multiple days of negative funding, and that to me is quite a meaningful thing. It's like you've been sort of hurt, right? Like the velocity of the deleveraging, because like a 20% move to the downside or decrease in open interest over the course of 1 week versus a 20% decrease in open interest over 3 months is a very, very different thing for the mind, for the human psyche. It instills this like fight or flight mode. Well, for those that aren't prepared anyway, and like say you do get beat up by it, and you were long into a deleveraging, they're fast, they're sharp, they're not fucking comfy. And it changes the psyche, and then like that shift in psychology, it then manifests on the tape by people shorting the market aggressively. And when people are shorting the market aggressively, a la the bottom 23, like back end of 22, or September to October, post the August flush in 2023, or post Volmageddon 2024, August, September into October. So you have these long periods of confidence in the market, right? And then that shifts. You get an aggressive move, and it scars the psychology of the participant that got caught offside. And we've not seen that. OI is 7% off the highs. We've had this slow and steady gradual move down. Like, yeah, we got liquidations the other day, but what? Price was 2% down. We saw a more aggressive rate of change in the decrease of OI across the board on alts. And just to add here, this isn't, a primary point, but just to add on color and context around the move in alts, an observation I had the other day post that deleveraging in alts, post that liquidation move, was like, it made the market show its hand. You got 15 to 20% moves across the board on these alts, right? And there was no bounce, right? That's like going in an auction house and going, price being propped up, it getting dropped 20%, and then still nobody putting their fucking hand up going, yeah, I want this at a 20% discount. Nobody fucking wanted them. So then, yeah, like, of course, like BTC and sort of ETH had this short squeeze on Sunday, Monday, and like alts pop a little bit, but there's no fucking bid here. So that does concern me. And anyway, so like, that's just one point regarding alts, and like, we've not had the sharp aggressive move on BTC yet. And we've still got people like itching to sort of call the low, like people, lack patience, I think. So, like that's it from sort of the idiosyncratic spending side, like long-term holders, they're spending, they're moving a lot of coins right now. And that doesn't fill me with a world of confidence, given that looks sort of textbook distribution. You'll see in the chart. Then you've got the leverage dynamics. We've still yet to have a meaningful unwind in BTC OI. We've still yet to have the shift in psychology where people go, fuck, it might be over. We haven't had that yet. Haven't had it. Do I think we can go to a new all-time highs without flushing positioning and having that? I don't think so. I think it's actually a requirement. In my view, obviously not fucking hard science. Okay, next point, right? And it's Nvidia. I posted a chart a couple of weeks back, or like a week or so back, and like kind of just some like higher level divergence that we were seeing, right? We did get some news, did get some narrative for Nvidia. We have popped into the highs. That has actually made me more bearish. I see a weekly setup now, a weekly momentum imbalance, akin to the one we saw in Jan, and akin to the one that I labeled and like highlighted with BTC in Jan, Feb as well. Right, this is, risk is to the downside here until invalidated. Until we break these highs convincingly, this really looks like distribution. It looks like distribution, and I just don't like it. I don't like the biggest company on the planet, right, which is the head of the AI trade, basically fucking large chunk of the index now, looks like this, I'm just not going to go against my system. Just invalidate me and that's fine. Invalidate the system and that's fine. Like, I am not getting bulled up when Nvidia's tucked under its highs like this. It's the V. Uh-oh. Spaghetti-o. And do I know the catalyst? Do I know the vector? Which sort of, not too sure. Don't really know. But the longer it hangs out up here, without breaking the highs, the sketchier it becomes, in my view. Right, and we haven't had Nvidia correcting to the downside and also seen the indexes and Bitcoin moving to the upside. So like, they're kind of mutually exclusive. Like, I don't think we're gonna get a run on the index or a run higher in BTC and crypto while Nvidia is trending to the downside. There's just too much psychology around that asset, around the AI trade, for like Nvidia to trend higher and the rest of the market, Nvidia to trend lower and the rest of the market to be fine. I'm not having it. So Nvidia, that is another point. Just generally like the liquidity picture on the US side, like bank reserves, you know, with respect to liabilities, and just generally like US banking liquidity right now. We're seeing it through the sort of funding market, elevated levels of stress right now. Look, I'm not a liquidity expert, like, and I've said this time and time again, but back a month ago we said like things just like aren't materially increasing. So unless we get a policy pivot towards balance sheet contraction, then yeah, like that's just another thing to linger. Like, we don't have like abundant liquidity right now. Bitcoin's a fucking liquidity sponge. You know, what's there to absorb here? Like, I'm not sure. So that's that, like more of a minor point, like, because it's not my area of expertise, but like just generally speaking, it is a slight cause for concern unless we get a policy pivot. Something else which obviously I monitor quite closely is credit spreads. And what we've basically seen for the past month, so I think it was 28th of August, basically since my last video, is like C's with respect to high yield have been widening. So like, just to give that context for those that aren't aware, that's like, you know, the shitcoin market underperforming ETH. Like, ETH's still an alt. ETH high yield, C's are like your tail end shitcoins, right? And like, when do your tail end shitcoins work, you know, perform best? When there's abundant liquidity and it needs to find a home down the risk curve. So like, that's a point. We have seen widening for a month now, and also alongside net widening, like sort of over a 90-day period as well, like we have seen, which is like a metric I like to quantify spreads with, we have seen the max acceleration on that contraction. And like, once again, when has been a good time, people are like, oh my god, credit spreads are super tight, like must get long. Well, like, I just view that differently. People like, I'm like, that you've already had the fuel, you've already used the fuel. Like Volmageddon, we got spread widening. Like, you want to get long when spreads have widened, and then there's fuel to contract. You know, April lows, like spreads were wide as fuck. Like, that's when you want to be looking long. Like, once they're already like, once we've had the max acceleration, well, kind of contraction, the second derivative, it's like, you know, the juice has largely been squeezed. So like, that's another thing. Like, credit spreads to me aren't signaling here like capital is moving down the risk curve. In fact, it's the opposite. It's moving up the risk curve. So that's another point. Yeah, and just like another one is like my fucking nuts as well. Like, my nuts are pretty good at telling me, you know, at inflection points, and like, it feels disgusting and it feels uncomfortable to like call a low and to like be bullish at the low, and like, this doesn't feel like it. It doesn't feel like it. So like, you know, that's just another point, is like my intuition. And like we've had a what, 12% correction? It's a correction for ants. We know what Bitcoin likes to do. Overextends in both directions. So yeah, the base case is unchanged. The base case is we head lower, and that's fine. We will have our bull goggles on, right, as we trend lower, as the reward side of the spectrum the reward side of the equation increases as price drops lower, and like there is a Goldilocks scenario in which you get a deleveraging, which coincides obviously with prices getting lower, so your reward side of the equation increases, and the risks given, you know, like I've outlined, the deleveraging not happening is still a risk. So if the deleveraging happens, it's a double whammy, right? That's your fucking Goldilocks long. And it'll feel disgusting, it won't feel nice, but that's the fucking point. It feels nice to get long here, but to get long here is a bad apple. All right, ciao for now. About to get run over.